Okay, welcome to the Killik & Co podcast for the 20th of May. Equity markets again had another strong week. The American markets were approaching 2% up and keeping this trend going that we've seen really since the mid part of April of almost unrelenting rising markets, equity markets across the globe, led of course still by Japan. US is still strong and the UK playing a little bit of catch up. Last week we had strong performances out of Japan and helped by news that GDP expectations in Japan were responding favourably to the economics that have been introduced since the new government was introduced. Here in the UK, banking shares continue to be a feature, and we've seen gains of 33% from Lloyds Bank in the course of the last month alone. Similarly, RBS up 25% and Barclays up 15% indicate that that's a sector that has been performing strongly. On the downside though, miners have been or continued their weak performance. Commodity prices are lower. We'll take a look at silver, which has been falling recently, and that is one sector that is just holding back the FTSE performance at the moment. Key question is when that will turn. Still continuing to see some strong divergence in currencies. Whilst the Japanese yen has been particularly weak over the course of the first few months this year, it's the Australian dollar that in the course of the last few weeks has dropped by about 8% against the dollar, and that is having ramifications for some mining stocks. So let's first of all turn to this week. This week we will struggle for much informative economic news, but we'll have plenty of businesses to report results. Here in the UK, we'll have retailers Marks and Spencer's and also Burberry, and we'll also be hearing from Vodafone. This morning we've heard from First Group. They were scheduled to report results on Wednesday, but it looks like concerns about the level of debt for the transport group that owns Greyhound and also many of the bus and rail businesses here in the UK. The debt pile of £2 billion could have been subject to a downgrade by some of the forecasters for debt, and as a result they would have been incurring much higher cost to their financing. And this was let down recently, you may recall, by a franchise problem. The government handing them a franchise to run the Great West Railways from Virgin, but that was successfully challenged, and the delay there meant that the anticipated cash flow from that franchise didn't come through to support what has been struggling performances in the UK bus and US student business. As a result, they are now coming for a 3-for-2 £600 million rights issue this morning, and the shares are down 20% on the back of that company. So let's just turn to some of the charts for the week. The FTSE 100, as I say, since April, the 22nd here, has been on this rise. I'm still convinced that what we're seeing here is that as tail risks have reduced of potential problems in Europe on the financing side, that markets have concentrated on earnings yield and are prepared to pay higher prices and to accept almost lower returns to buy good quality equities. And if this is the case, if this is what is driving equities, then I suspect there still has some way to run given the divergence between equity earning yields and other yields elsewhere. So that is a trend that is underway, and we'll take a look at some of the key beneficiaries of that particular trend. In terms of some of the equities that we're observing at the moment, we have seen a good performance out of BG Group. Last week they held their strategy day. Just as a reminder, you may recall here they had a profit warning. This was driven by lower production. Since that time it's been a case of generating, with a new CEO, some traction of goodwill with investors, and I think the strategy day last week was very well received, and we're starting to see BG Group reclaim its sort of levels pre that particular warning. So that again remains a stock we like, and I'm happy to still circulate anyone looking for research on that stock our update from last week. Just want to look at some of these mining stocks, because obviously we have got these unrelenting rising markets, but it is the mining sector that is moving in the opposite direction. Rio Tinto here, we can see this is really since the year to date has been heading in a downtrend and very much towards the bottom end of that range. So it potentially is bringing in some bargain hunters here at the moment, but it is a game at the moment of confidence within the commodity space, and with underlying commodity prices still under some pressure here. here. We do know that these mining stocks are really cutting capital expenditure very, very hard at the moment, so we've got to be very careful with companies that are exposed to the service side of these businesses, because CapEx is coming under some pressure for the sector. That's Rio Tinto. This is Anglo American, one of the weakest. It has the geographical risks as well of Africa, and again very much towards the bottom end. And Billiton, we highlight Billiton here only because of its potential exposure to the Australian and dollar, and again we'll take a look at that particular currency in a couple of charts' time. The Aussie dollar we have here has moved by about 8% during the course of May, and really, as I say, weakening quite sharply following what we've been seeing with the Japanese yen. Turning to commodities, this is the price of silver. It is the talking point this morning. They're talking about some forced liquidations in silver as of Monday morning out of Japan, and that is causing, really, as I say, this was trading at 34 towards the end of 2012, down to 21, so very significant moves in the silver price there. So in terms of Japan, really just worth highlighting, as I mentioned, the GDP beginning to respond to the economic programme that was put in place over 6 months ago now. Look at the strength of that rise in the Nikkei. It's virtually doubling now from those low points that were achieved last year. So it is the runaway leader, and as I say, the weakening of the yen, which has pushed it now through to 102, doesn't appear to have subsided at this stage. So still very much the momentum trade behind Japan.